As you know, I always like to say or predict what the next Fed rate increase is going to be a day or two before. I've been thinking that the Fed was going to raise rates 25 basis points for the last month, including when Silicon Valley Bank failed. And that was not an easy decision. But now that time has gone on, it's been a much easier decision. And the probability, the futures markets are agreeing with me that rates are going to rise. Here it is, 25 basis points when the Fed meets May 1st, May 2nd, I should say. And I'm going to give you a whole bunch of data of why. So maybe first we should go talk about what's on my screen here. So we've had 9 rate increases, believe it or not. This is one of the most rapid increases in rates we've seen in history. But, it's really hard to tell because what do we mean by rate increases? Are we talking about an absolute basis or percentage basis? On an absolute basis, this is one of the largest rate increases, but not the largest. On a percentage basis, yes, this is the largest rate increase in history. So let's go back because it's important I show you this data here because I have to talk to you about the next point that I'm going to make. So I'm setting you up here. Here's the setup. We started raising rates on March 17th of 2022, and then we lapped them in the last month. So that's how we got to over 1 year of rate increases. So we raised rates 25 basis points, 50 basis points. Now this is where it gets really important. Then it was 75, 75, 75, 75, and 50. So what I'm saying is, beginning in May, especially during the summer, the Fed raised rates aggressively, meaning they raised rates 50 to 75 basis points. That means, if you look at the lag, that the economy is not going to get hit because the economy gets hit about 1 year later. It takes that long. It could be even more, 1 to 2 years after a rate increase. That means the economy is not going to get hit until 1 year after those big rate increases. So here, if you look at the screen here, the big rate increases occurred in the summer and maybe fall of 2022. That means the economy is not going to get hit fully until this summer and fall. So I think we're going to get a recession around that time. I've been wrong because I didn't account for this lag, but now I'm accounting for it. So let's look at the probabilities, the betting that's going on in the CME world. This comes from the CMEgroup.com website. And now this rate increase has seen, this 25 basis point rate increase is up to a 91.5% probability. You can see here that's going to go up to the top of the range is 525 basis points. So now that's where we are. Now I was calling for this 25 basis point rate increase when this probability was much lower for other reasons. Now I'm going to give you some more reasons why I think that not only is the Fed going to raise rate 25 basis points, which everyone is saying no kidding, but what I'm going to tell you is that the Fed is also going to be hawkish in its commentary and in its press release that's going to come out later after the rates are increased. So let me give you these reasons. First of all, there's lots of hard economic data that remains inflationary and also shows that the economy is strong. For example, we've got this guy here on CNBC talking about the core PCE. It was up 4.6%. I'm not going to play this for you, but it was up 4.6% versus 4.5% estimated time. Now, if you're looking at any type of pricing data, it's been good. It's come way down from the top. Overall pricing data was up between, 8% to 10% at the peak. And remember, there's lots of different pricing data. CPI, core CPI, PPI, core PPI. The one I showed you here, this is a personal consumption expenditure index of inflation. This used to be called the Fed's favorite inflation data, but now they're looking at some kind of trimmed inflation data. They're looking at data that excluding housing costs because everyone's saying that housing cost is delayed. But Either way, here's my point, that no matter what inflation gauge you're looking at, it is about double where the Fed wants it to be. So remember, the Fed is aiming for, they've got a dual mandate. I would say triple mandate. The dual mandate that's official is low employment, low unemployment, and low prices. By low prices, they're talking about a target range of probably CPI or PC being around 2%. So no matter what type of pricing data that you're looking at, even though it's come down dramatically, we're still about double where the Fed wants it to be. That means the Fed's going to keep liquidity tight. It's going to keep raising rates. And even if it does, it's going to raise and hold. It's not going to pivot like the market's thinking. So let's go forward and look at some other data. Now, if you look at the GDP growth, it was up 1.1% for the last quarter, but that was a headline number. The actual number, the one I look at, is final sales, final sales, which excludes the ebb and flow of inventory. That number was very good. It was up 3.4%. And that is like extraordinary strong number. I mean, think about it. At this point in time, if after the Fed raises rates 1%, over 1 year, that number should have been negative, at least a small negative, and it's not. So it shows you how strong the economy is. I'm going to show you some more data points. This just came out. The PMI, there's two or three PMIs. They all were good. S&P PMI, I believe, is at 50%, which means the economy is growing. Now, this is a PMI that's been out for many years, and this comes out from Timothy Fiore from the Institute for Supply Management, and it was at 47.1%, but it was higher than expected, and it was up from the previous month. But what I'm going to focus on is this. If you look at new orders, they were up in April versus March, but look at the pricing data. Prices were 53.2% versus 49. That's the biggest gain in many months. So that's a real negative. You don't want to see prices coming back up. And that's a problem with inflation. It gets very stubborn. And if you remember, oil prices are cheap. They're very low now. There's a possibility that oil prices could go up again too, and commodity prices could go up. Remember, commodity prices have been the ones that have been leading this declining inflation. And I'm going to talk about China, then I'm going to talk about some other data. You have to remember, China is very important. China is adding liquidity to the system, number one. And number two, because they reopened their economy, their economic growth is strong and stronger than expected. So for the last quarter, it grew 4.5%. You could see it on this chart. So now, before I end it, I want to put everything together just to show you how strong the economy is. We already talked about prices. That inflation, while it's been coming down, it's 2 times higher than what the Fed wants it to be. So let's put it all together. I'm trying to think of all the data I've got to say. So I talked to you about the 9 rate rises. Fed fund rate rises included 4 increases of 75 basis points. I didn't talk to you about this, is that when the Fed first raised rates, it affected industries that are affected by short-term increases in rates, not long-term. So the ones that are very sensitive, this includes banks, and it also includes housing. Remember, anytime the Fed raises rates, the mortgage rates goes up instantly, especially when the 10-year goes up, because the 30-year mortgage rate, for example, is tied to the 10-year rate. So those industries already got affected. I don't need to tell you about Silvergate and SVG, Silicon Valley Bank, and the failure of First Republic Bank. These and Signature Bank. These are examples of where the increases in the rates affected some industries, but not all. So we reached part 1 where the economy or certain aspects of the economy slow, but the economy still hasn't been hit by the Fed rate increases for the reasons I told you earlier because of the lag. So now what I want to talk to you is about economic indicators. They've been very strong. I'm just going to give you a few of them. So I already mentioned a few. Number 1, GDP growth has been strong, especially final sales. I already talked to you about inflation being strong, and in ISM, some indices have been stronger than expected. So that's hard data. Now, what we've seen that's been weaker is the soft data, and this is the ISM survey data. It's been weaker, but not weak enough. So if we put this all together, it's shown that the economy will be hit by summer. I would say very soon, by June, July, you're going to see a decline in GDP growth. And the stock market is probably going to get hit because earnings growth is going to slow down. Before I go, I just want to show you one last thing. This comes from Raoul, who does a newsletter, and he co-owns Real Vision. And in I subscribe to one of his newsletters, and he does like coincident indicators. I'm not going to go over them, with you. I'll just talk to you about one or two. But what he likes to do is either look at a chart that has M2 money supply versus Bitcoin, or M2 money supply versus stock prices. But he also does it with the ISM index, the Purchasing Managers Index. And what he does is he tries to figure out what the ISM should be, which is soft data, based on other economic data. And here's an example. So here we have the ISM index, his forecast based on overtime hours. And you can see in the blue, it's lower than the white line, which is ISM. So he's saying the ISM index should be lower for many reasons. This is one reason. And he goes on and on showing this chart. I'm just going to minimize myself. So he's going to go on. And so I'm going to, like I said, show you one or two. This is Philly Fed data, which is going way down. You can see in the blue line here. So it's also signifying a lower ISM. And then he's got Chief Executive Officer confidence is also low. And then he's got the NASDAQ showing that the ISM should be lower. And then he's got the financial conditions in there. Now this one's different. This one, and I mentioned it earlier implicitly, is showing that financial conditions are actually going up. I think they're going up, but I'm not sure if this is short term. It might be due to the upcoming debt ceiling and the liquidity going on in the market from the US because of that. And that comes from the Federal Reserve General Account, or it could be coming from the liquidity that I mentioned coming out of China. So this chart's a little strange. It's already showing that financial conditions and liquidity have bottomed. And this is global ISM data. And then this is commodity inflation shown. This is showing that inflation's coming down. So overall, I just want to end it here. So overall, I just want to tie it all together. So when the Fed meets on May 2nd, just to summarize, the Fed's going to raise rates 25 basis points. I think the Fed's going to be hawkish in its commentary, in its written commentary, and it's going to be hawkish in the press release. And so I think what's going to happen is going forward, there's going to be some pressure on stock prices. And I think that finally, I know I've been early on this, I think the U.S. economy is going to start getting into recession mode. And I didn't mention these indicators, other indicators like the leading economic indicators, which is also predicting the recession. But what I want to say is that now finally, after a lag, it looks like the economy is going to be hitting a recession. Now, people are saying, we've already passed. I've heard quotes on CNBC today and Bloomberg. The quotes are saying that we've, quote unquote, have passed the acute phase of the banking crisis. My friends, I don't even think it's started yet. I did a video about this a month ago. And in that video, when I talked about Silicon Valley Bank going bust, I said that Silicon Valley Bank was our new century moment of March of 2007. And remember, the Dow Jones hit a new high in October of 2007. Because what we did is we put a bandage on it. And then we put a bandage on the Bear Stearns hedge funds that went bust. And then we couldn't price money market accounts. We saw that from BNP. They couldn't price 3 money market funds. And we put a bandage on that. But my friends, what I'm trying to tell you is we have not hit the acute phase of the banking crisis. What we had is a liquidity crisis. And that's different from what I'm seeing is a credit crisis. That's going to be the real crisis, a credit crisis. That's when you see investment grade and high yield spreads go up, and you're going to see lots of bankruptcies in the commercial real estate area. I'm talking about not all hotels here. I'm talking about, or even multifamily homes. I'm talking, or buildings. I'm talking about conventional office buildings. You're going to see bankruptcies coming out of that, like Blackstone portfolio companies going bankrupt. So put on your seatbelts and enjoy the ride. Bye bye. Thank you.